Have you ever wondered how countries like Kenya navigate the rough seas of global finance? It's a question that many of us might have pondered, but never fully understood. Countries like Kenya, despite their emerging economic stature, must grapple with a world of finance that is often far from simple or straightforward. You might be curious to know how they manage their finances on a global platform, how they secure loans or finance their developmental projects. After all, they are not just competing against other nations, but also dealing with complex international financial systems. Moreover, another term that often arises when discussing global finance is Eurobonds. Eurobonds might seem like a complicated financial instrument, a labyrinth of unfamiliar terminology and concepts. However, it is indeed an integral part of international finance. But what does it mean? What role does it play in the finance of countries like Kenya? Remember, finance is a vast and complex subject. It involves numerous mechanisms, instruments and strategies, each with its own set of advantages and disadvantages. It's a world that can sometimes seem overwhelming, even for those who deal with it on a daily basis. But fear not, because today we're going to unravel these mysteries and more. Together, we'll dive deep into the world of global finance, demystifying concepts like Eurobonds and discovering how countries like Kenya steer their course in this turbulent sea. So, what exactly are Eurobonds? The term may sound complex, but in essence, it is quite straightforward. Eurobonds, as the name suggests, are bonds that issued in Europe, but they are not limited to just Europe. They can be issued internationally. They aren't, however, issued in the home currency of the country where they are issued. This is what sets them apart from other types of bonds. The concept of these international bonds came into existence around the early 1960s, marking a significant milestone in the history of international financial markets. Their emergence signaled a new phase in capital mobility across borders. In the ensuing years, Eurobonds have continued to play a significant role in shaping international capital markets. Their value significance have grown exponentially, transforming them from just another financial instrument to a major player on the global stage. The relevance of Eurobonds further extends to the developing economies, where these are now seen as a significant source of capital. Countries like Kenya, among others, have increasingly turned to Eurobonds to raise capital for various development projects. This is in the hopes of boosting growth and development, reducing poverty, and enhancing the standard of living for their people. To summarize, Eurobonds are not just financial instruments, they have become vital tools in the pursuit of economic growth and development in many nations across the globe. They've been a significant part of international capital markets since the early 60s, and today they represent a major source of capital for many developing economies, Kenya included. But why are Eurobonds so significant? The answer to that question is multifaceted and of great importance, considering the global economic implications. To begin with, Eurobonds can be seen as an essential tool that countries utilize to generate large sums of money on an international platform. It's a financial strategy that empowers countries and allows them to tap into the vast resources of worldwide investors. The first point of significance lies in their ability to facilitate the raising of capital. Countries, large or small, developed or developing, can leverage the power of Eurobonds to raise substantial amounts of money in international markets. This is crucial for funding large-scale projects, supporting economic development, and fueling growth. Additionally, Eurobonds serve as a catalyst for diversification. They open doors to a diverse array of international investors, enhancing the borrowing country's investor base. This is not just about numbers, but also about enriching the blend of investors, leading to increased stability and resilience in their financial ecosystem. Moreover, Eurobonds can act as a safety net. They have the potential to decrease a country's reliance on domestic borrowing, thus mitigating the risks associated with it. Since domestic borrowing can often be a pricier endeavor, shifting towards Eurobonds can, therefore, bring about substantial cost savings. In conclusion, they can also help to reduce a country's dependency on domestic borrowing, which can often be more expensive. For Kenya, the story of Eurobonds is a tale of $2 billion. This narrative traces back to the eventful year of 2014, when the East African country made an audacious financial decision. In a move that challenged expectations and underscored Kenya's economic ambitions, it issued its first ever Eurobond, a financial instrument dominated in a currency not native to the issuer's country. This Eurobond was not a small affair. Its worth was a staggering $2 billion, an amount that put the country on the map in the sphere of international finance. This was not just historic, but also pioneering in its scope and scale. It was, in fact, the largest debut Eurobond issue by an African country at that time, setting a precedent for other nations to follow. This Eurobond wasn't issued on a whim, it had a robust purpose. The funds raised were earmarked for infrastructure projects, key to Kenya's development agenda. Beyond that, they also intended to manage the country's debt, helping to maintain a healthy fiscal balance. In Kenya's financial journey, this Eurobond represented a defining moment, a strategic leap towards economic growth and stability. The funds were intended to finance infrastructure projects and manage the country's debt. However, as with any form of borrowing, Eurobonds come with their own set of challenges. To understand these challenges, one must understand the function of Eurobonds. Essentially, they are international bonds issued in a currency other than the home currency of the country where they are issued. This financial instrument brings about an opportunity for the issuer to borrow money from international markets in a currency that can provide certain benefits, such as lower interest rates or a more stable foreign exchange rate. However, they are not without their pitfalls. Firstly, Eurobonds require diligent management of the country's finances. This means the country must have a strong, competent financial management team in place that can keep track of all the complexities involved in the issuing, management, and repayment of these bonds. Secondly, a clear strategy for repayment is necessary. This involves understanding the country's economic growth, its future revenue streams, and its ability to service this type of foreign currency debt. Planning repayment without a lucid repayment strategy can lead to a debt trap, a situation every country wants to avoid. The case of Kenya further illustrates these challenges. For Kenya, these problems have been particularly acute, with concerns raised over transparency and accountability in the use of the Eurobond proceeds. This underlines the importance of careful management and clear repayment strategies when a country decides to issue Eurobonds. The story of Kenya's Eurobond experience is a multifaceted one, echoing the intricate nature of the global financial landscape, serving as a testament to the delicate equilibrium that nations worldwide must strive to maintain. The Eurobond narrative in Kenya is not just a financial tale, but a socio-economic one that has seen the East African nation grapple with the realities of accessing funds from the global market. Kenya's Eurobond journey kicked off in 2014 when it became the first East African country to issue a Eurobond, thereby making its debut on the international capital market stage. The event was met with great enthusiasm, a testament to the potential that investors saw in Kenya's growing economy. However, like all risky endeavors, it was not without its share of controversy and challenges. The main criticism of Kenya's Eurobond experiment revolves around transparency, accountability, and the potential for fiscal mismanagement. Critics argue that while Eurobonds offer an attractive means to raise capital, they pose risks such as increased indebtedness and potential for misuse of funds. Despite these controversies, Kenya's Eurobond experience has not been without its benefits. The issuance of Eurobonds has allowed the country to diversify its sources of finance, reduce its reliance on traditional sources of aid, and foster economic growth. It has also motivated the Kenyan government to undertake necessary financial reforms to maintain investor confidence. As Kenya continues to navigate its way through the complexities and opportunities about by Eurobonds, it serves as a compelling case study for other developing economies seeking to tap into the power of international capital markets. The lessons learned from Kenya's Eurobond experience provide valuable insights into the potential risks and rewards of engaging with global finance. In this fast-paced, interconnected world, the Kenya Eurobond experience is a pertinent reminder of the delicate balancing act that countries must perform in the world of global finance. As Kenya navigates through the challenges and opportunities presented by Eurobonds, it offers a case study for other developing economies looking to leverage the power of international capital markets. In summary, today we've explored what Eurobonds are and why they are significant. We've delved into the story of Kenya's $2 billion Eurobond issuance and the challenges and opportunities it presents. And finally, we've touched on the broader implications of Eurobonds for developing economies. So the next time you hear the term Eurobond, you'll understand the significant role they play in global finance and the challenges and opportunities they present for countries like Kenya. Remember, knowledge is power, and understanding the complexities of global finance is a key step towards making sense of our interconnected world.